Welcome to the Best of US's Morning Edge, where a couple weeks ago we discussed risk management. We took a number of days to talk about the different types of risk management and things you need to take into account when building a risk management plan. So today I'm going to take you through that and share with you how to risk manage your investment portfolio. So let's get going. First off, asset allocation. That's one thing you've probably heard a lot about, but what exactly is a good asset allocation per asset class? And in this chart, you can see here, we have it broken out to fixed income, equities, commodities, and options, and max per position size. So let's start off with fixed income. This is bonds, this is CDs, this is cash in a sense. So when we look at fixed income, we say 10% to any one position. So you could have four bond positions. Let's say you had the Lehman Brothers Aggregate Bond Index, AGG ETF. You had US Treasury 7 to 10 year ETF, IEF. You had TLT, which is the 20-year US ETF Treasury ETF. And let's say you had some high yield in there. So HYG was your ETF. You have four positions. At a max, you should allocate no more than 10% to each of those positions, basically adding up to 40%. And the reason you want to do that is in fixed income is one, you can allocate more to it because it's slower moving. It's not as volatile per se versus equities. And so max allocation per position in fixed income should be no more than 10%. In equities, this is up for debate, but I believe between 6 and 8% is a max you should have. The portfolio, the 12 that I run, it has 7 equity positions and 5 cryptocurrency positions, and the max allocation to any one of those positions is 8%. Your portfolio, most of the time, unless the whole thing goes to zero, can handle an 8% drawdown in a portfolio. So 8% max. The key to this is how you get in up to 8% and how do you get back down to, let's say, a minimum of 1%. Is dollar cost averaging in and following a trend in a sense of how those equities are moving. Commodities, if you're buying copper or platinum or any of lumber or something like that, a max of 4% to commodities. And the reason is because commodities are much more volatile. Equities are less volatile than fixed income, and commodities are more volatile than equities and fixed income. And then you come to options. Some of you will never buy an option contract, and some of you will only trade options. But having no more than 1 to 2% allocated to any one option position is really key because options have a lot of factors that actually work against them. It could be market movement that would deteriorate a position. It can be time that will deteriorate a position. So options are very volatile. They're in most cases very liquid, and in some cases they're not very liquid. So having a max of 2% allocation to options can really save your rear if it works against you. What the key to all this is you don't blow yourself up, that you don't take an account that you worked hard for, you save the money, and you allocate to one position and you blow yourself up. That is what we're trying to avoid when it comes to asset allocation. Now, let's get into trends and how to use trend lines to determine how much risk you put on and how much risk you put off. So this is the S&P 500 ETF, SPY is the symbol. This goes back to December of 19. It's a daily chart here. And so this gives me a picture of what the trend in the last 5 years or so, the S&P 500 ETF SPY has been doing. And it gives me a couple different views. Well, first off, what I'm going to show you is 3 trend lines that I use in my risk management process. You will determine yours eventually if you haven't already. but I'm going to use the 200, which is this. This is the 200-day moving average. I use this as my baseline, this is my foundation of my process. And so if the stock price, like for instance, back here in March of 2020, the stock price broke through the 200, closed below it, and then moved south. It then recovered back in May or so, early June, and closed above it, confirmed, and moved higher for the basically 2 years or so, and then broke it again. So I'm using this baseline as my long-term indicator of what the trend of the S&P 500 SPY ETF is. I then add, in my case, I use the 62-day moving average. And that is the yellow line here. Why the 62, you may ask? Why not the 50 or why not the 20 or the 9? Well, in particular, I use the 62 because if you take the number of trading days a year divided into 4 or divided by 4, then you have basically a quarter of the year. And since so much is reported on a quarter of the year, quarterly earnings, government numbers, and many other things, I use the 62, and it gives me a leading indicator to what is to come. So if back here in, say, February 25th of 2020, stock price broke through the 62-day moving average. That to me is a big indicator that, hey, something really is changing. So I may de-risk my portfolio. So I take my equity positions down from a max 8%, and I start to dollar cost average out, taking my profits and leaving a little bit just in case this is a rebound upward. But in this case, we saw it eventually bottom out. SPY bottom out in March 23rd of 2020 and start to move back up. Having a little exposure, say 1% exposure, yes, I'm taking a loss there. But as it recovers, I'm still in the game. And as the stock price broke through the 62, I start to dollar cost average into my max position. Once the stock price broke through 200, I had a little bit more and I get confirmation here, and then off to the races we went and start to build my max position here. And I follow that all the way up. I have a couple blips below, but I maybe take a couple dollars off a couple basis points off the table. I'm still above the 200. That's my leading foundational trend. And then eventually a breakdown through it again. So I de-risk my portfolio down to my minimum allocation and then move forward. So I use that 62 as my leading indicator on basically a quarterly trading day basis. And it gives me a better understanding of what is going to go on in stock price and how to leverage, to add in or subtract off my allocation. Now let's add in the 15-day. And the 15-day is, most people use the 20, I use the 15. You're going to determine what works best for you because as time goes on, you're going to build your own process and your own trend indicators to give you a better idea when the stock is going up and when it's going down and when to put risk on or take risk off. The 15 is a front runner to the 20-day moving average. So I'm trying to get ahead of what's happening. So back in February of 2020, we saw it move through the 15, gap down actually there. And that gave me an indication that, hey, something really is going on, something big. And we had the 15 cross through the 62. That really means, ooh, I may want to really de-risk here. And once the stock price broke through 200, then I go down to my minimum allocation number. And I use that on the way up as well. So these are my 3 indicators. You, on the other hand, will create your own 3 indicators. Maybe you follow mine. Maybe you follow somebody another pattern or another way. So there's always different allocations, but the main ones are the 200. A lot of people use the 50. I use the 62. A lot of people use the 20. I use the 15. But you're going to figure that out because you're going to get an idea of how you think when it comes to investing, both short term and long term. In this situation, I can apply this to any time frame, and it gives me a leading indicator to what is happening and where markets are going. Let's talk about support and resistance as a risk management tool. Now we're back to the S&P 500 SPY ETF. All right. So when I look at this, this is a going back roughly 5 years in time. And what do I see here? Well, I see a lot of squiggly lines going up and going down, going up and going down. But when I start to look at this, and I like to draw, so I like to use, in this case, support and resistance. So let's just, the most obvious one right out of the gate is this support level here. I have one touch, two touch, that became resistance to the S&P 500. And then once it broke through it back in, so it basically got denied. This became resistance back in January of 22. And this then became support in January of 24. That's 2 years. That's so crazy, right? But this is a big resistance level. And as we see here, we came down to that close in April of 2025, but got close and then moved higher. You could actually say, you could move this up just a tad here, and you would have had basically that move down in April was a test or close to a test of this long-term support and resistance support level, and at one point resistance level. Now let's draw another one. And you have, in this case, where to span a little bit more, where we had the peak here in February of 2020. And so right around here, that was another support. This event here in February of 2020 created a resistance level. It went up, it broke through, it became resistance here. And on June 11th, 2020, it got denied, went back at it in July of 2020, and eventually broke through it. It moved higher, and then went and confirmed that this resistance, what once was resistance, then became support. And that's where you had a jumping off point as of November of 2020, and you moved higher. Eventually, market petered out and created another resistance level. 1, 2, tried again, 3, and then the market moved down lower. You could actually draw another support level here. This is back in February of 2020. Market went up, it closed lower, tested support here in September of 2020, tried again in October of 2020, got denied, went back, tested support in October of 2020, moved higher, and eventually broke through it in November of 2020. That's over a 3-month period of time that this whole process happened. But what it tells you is this is a solid base of resistance, but once it broke through, it became eventually support as of June of 2022, again in October of 22, and a move higher up into eventually what this became resistance. This became resistance here, and over a month's period of time, it became what I would say eventually became support. Market moved higher, came down in April of 2025, just a month ago, and made a test of it again, and then bounced higher. So now, well, going forward, where is the potential for resistance? Up in this area? Well, that could be possibly right around here. That could be another resistance level. Now, if the S&P 500 ETF SPY moves up, pushes up against, say, just to say 600, which is really a actual, let's drop this down a bit. bring it down to 600. This is an area of to be noticed. It's an area of concern because this had because of outside equity markets, so derivatives markets, this is sort of the line in the sand for the derivatives market. So we're going to make a move higher up to another 10 points up to 600. This becomes resistance, and then we could have a pullback. Now, let's get sort of small in this case. We'll change the color here. And what could be resistance at one time? Let me change the color a little bit. Let's caution. We'll make it yellow. And right here, this became resistance back in July of 2024. It retraced. Heck, you could see here another resistance level as well. A resistance that now becomes support. So you have what I would call mini support or sub-support and resistance levels here. So we could easily see a pullback in the S&P or move to 600 on the S&P, a pullback then to 565. That could be confirmed as support. If not, maybe a retest of the near the April lows of 2025, and maybe this is support. Or it just all goes to hell in a handbasket and blows through to 478, and that support level, and the next support level there would be 356. But the likelihood of that happening, well, let's hope not, because that means a lot of things just went wrong. But what you can see here is you get comfortable with drawing lines on charts and seeing the different support and resistance levels. This can make you a better investor. This can make you a better overall short-term trader using these type of things as support and resistance. So let's just throw the 200 over this, and let's throw the 62 period move over this. And you can see how this all integrates into each other. So we start off, number one, asset allocation. What is our max to each asset category, and what is our minimum in each asset category? Then we move on to moving averages. I use the 200, the 62, and the 15. I use that for long-term and short-term. I use it on a weekly and daily charts. So those are my first two things. So asset allocation, how much am I going to put in max into each position? And then I look at how it trends. I want to see where the trend of the market is going. And then I look at support and resistance levels. Now, big question is stop losses, trailing stop losses. What is a stop loss order? Well, a stop loss order is to say the most that I am going to take in a loss from where I bought a stock. So let's say I bought a stock at $10. And let's say I use 7% as my stop loss. And so at 10%, I would be at $9 would be my stop loss. At 7%, I would inch it up a little bit more. So you could do that calculation on your calculator. I'm not going to do it today because you have a calculator. You can figure that part out. And so I would put that stop loss there that says this order, good till cancel, says if the stock price hits that stop loss point, say, let's just use 10%, $9 from $10, it is triggering a sell order to sell at the next tick, sell that stock or sell a portion of that stock. All right, so that is pretty easy to understand, right? You bought it at $10. You said I won't lose any more than 10%. So that would be $9 would be my stop, and I put that stop in there, and I put good till cancel. And as the stock moves higher, that stop doesn't move higher with you. And that's where a trailing stop loss comes into play. So let's say I use a trailing stop, and a trailing stop is really what the definition of, or the word trailing means. And that is it trails behind as the stock inches higher. So I initially buy my stock at $10. I then have a 10% trailing stop, and I put that at 10% below, and that puts it at $9. Now the stock starts moving higher, and it goes from $10 to 10.50. And so that 10% now moves up with it. So it goes from 10.50, that would be what, $9.50, let's just say. It moves up to that. Okay. Then it goes to $11. So then it's my trailing stop loss now sits at $10. I'm at my cost basis there. So I'm not going to lose anything if it goes through and triggers that trailing stop. Now the fun part becomes, let's say that position moves from $10 or $11 and moves to 15 or $20. Well, my trailing stop trails up with it. As long as I put a good till cancel order, it will trail in it as long as I'm in it. So if it goes to $20 from $10, that's a 100% return. Who ain't gonna want to keep that, right? So you have your trailing stop loss inches up, and now your trailing stop is at 18. So if the stock comes down and it triggers that trailing stop and you get sold out, you just made 80% on your initial investment of $10. And that's how trailing stops work. Now, in the environment where volatility is potentially high, headline news is driving conditions, adjusting your trailing stops or your stop losses is really key. And depending on the asset class, how close you put your trailing stops in needs to be considered. So, for instance, fixed income historically is not all that volatile. Now, I will say on February or May 21st, 2025, it is volatile. So, in a normal fixed income environment, you don't usually see 2 or 3% moves in a ETF like TLT. Historically, you're probably 1 or so%. So if you said, I'm going to buy this ETF, TLT, which is the 7 or 20 plus year Treasury bond fund ETF, and I say hypothetically it's trading at $100. And I know the volatility in that is maybe 1 or 2% on a daily basis in a normal market. Okay. And I say, okay, I'm gonna put my trailing stop at say 5%. There's a good chance it won't trigger out. Let's say it's more of this is a long-term investment. This is a core holding. I rarely adjust it, and I'll put my trailing stop at say 10%. Chances are you're not going to trigger that in a normal market environment. So you could have that trailing stop on for, well, ever and never get triggered. Whereas in equities, let's say you bought NVIDIA and you're buying NVIDIA at, say, $135 a share. Well, NVIDIA historically has anywhere between 3 and 5% daily movement in that stock price. That's pretty large. So if I put my trailing stop at 2%, chances are I will be out of it by afternoon after lunch if I bought it in the morning. So I may want to expand my trailing stop a little lower, especially if it's a more intermediate to long-term investment. Now, if it's a short-term trade, that's a whole different thing. You want to minimize those trailing stops or that loss in a sort of a swing trade or a just day trade kind of event. You want to keep your stops tight because losing trading capital can really work against you fast. So keeping those tight. Whereas if it's a long-term investment, maybe you base it off of in my case, the intermediate trend line or 62-day trend line. I put my trailing stop below the stock price. So if say NVIDIA is at 135 and the trailing intermediate trend line is 120, I may put my trailing stop calculated out percentage wise, or just you can also enter it as dollar wise, and I would calculate at $10 below or $15 below. And as long as that stock trailed up from 135 or higher, and I plan to own NVIDIA for a long, long time, that way I don't get stopped out anytime soon. It's a long-term investment. Or maybe you're really in a volatile market like we are today or have been for the last couple of months. I may want to inch that up to say, I put my trailing stop at 125 versus where I bought it 135, or I put it at 130 versus 135. It just depends on the market, the environment. The one thing I would encourage you to be active on is reviewing your trailing stops. If you're trading on a short-term basis, you review them every day. If you're investing in a long term and you have a wide spread between your trailing stop and your initial investment, then I would at least look at them maybe every Sunday, breeze through, see how close you are. Is the market turning? Are we seeing volatile markets in the coming, days ahead? And should I adjust my trailing stops up to accommodate the market environment? The biggest part about trailing stops and why investing needs to be a hands-on kind of thing, and you can be a long-term investor and check your portfolio and your trailing stops every, once a week, but taking an active role to preserve profits. Because if you bought NVIDIA, say at $95 at the bottom in April of 2025, and you're at 135 today, gosh darn, you just don't want to lose that profit. So you would adjust your trailing stops up to preserve that profit if you had a big gap between them in this case. So that's the three areas that I would say is to start when it comes to risk management. One, start with your asset allocation and your max positions and your minimum that you put on those positions. If it's a short-term or intermediate or long-term trade, it just depends, but risk manage through asset allocation. Number two, identify the use of trend lines. I use the 200, the 62, and the 15. Many others use the 200, the 50, the 20, and the 9. You will figure out your style and your process and what fits best for you. But that's the second thing. And then third thing, support and resistance levels. Learn to spend some time, go through charts, and mark off support and resistance levels. Get familiar with what creates a support level and a resistance level. Do that more and more each time. At least take 15, 20 minutes, 30 minutes each week and just look at charts and identify. And I used to print off charts back in 98, and I'd print them off at work, and then I'd go home and I'd take a ruler and I'd draw resistance and support levels, resistance and support levels. Once you do something over and over and over again and practice, you can start to identify these support and resistance levels. And then fourth thing, so there are four things: trailing stops, stop losses, and trailing stops. These can preserve your capital. Take it from somebody who has not done it actively early on and still at these sometimes get emotionally involved. And not having a trailing stop can blow you out of your portfolio. So get in the practice of looking at a position you want to buy, determining support and resistance levels, review the trends, determine the asset allocation amount you're going to put towards that position. Are you going to go full in right away? Or are you going to start with 2% and then dollar cost average into 8%, depending on the length of time you plan to invest in this or hold this position? And then determine where the resistance support level is, and then determine what your stop loss or trailing stop loss is. And then depending on if this is a short-term or long-term investment, go back and review those trailing stops. This is not all that hard to do. It takes work, I will say that. And like anything that you want to become really great at, it takes practice and doing it every week, every day, whatever kind of investor you are. But taking the time to make this work can really create enormous wealth. Just build a process, write it down, create some rules, follow those rules, and when those rules don't work, go back and review and ask yourself what worked and what didn't work, and always be flexible to adjust your process. There you go. That's risk management 101. That's how I would look at as you start out as an investor. But most importantly, the number one rule in this whole thing is not to lose money. And as Warren Buffett says, the number two rule is review rule number one. So put in the proper risk management process. Write it down, tattoo it on your body. No, that's not recommendation or advice there, but fall in love with the process of building out and building wealth. And risk management is your number one thing you need to focus on and determine how you're going to go about creating wealth for yourself. Thank you for your time. Hit the like button, the subscribe button. Join the best of US investors. We have different platforms throughout. And you know what? Always, always, as I say to everybody, always, always live loud. See ya.